Hey guys, this is Alex Owari from ONG Tax and Accounting Services. So this video is going to be the fourth and the final series that we're doing to cover the examples that's cited in Treasury Regulation 1.6038A-2, which mandates foreign-owned U.S. disregarded entities to file Pro Forma 1120 and 5472. And the focus here is going to be on 5472 Part V. Now, in the previous videos, we've looked at the examples that the IRS have provided in this Treasury regulation here. We looked at year 1, we've looked at year 2. The last one we did was looking at the examples in year 3. And in this video, we're going to take a look at examples in year 4. Now, before we take a look at the year 4 examples and go through the fact analysis and the conclusions, let me throw a word of caution out there that this video is for educational purposes only and it's not meant to be a legal or tax advice. And if at any point in time you need a legal or tax advice, always consult with a competent tax attorney or CPA who can listen to your situation and help you out. So when I started, I stated that there are some examples in the Treasury Regulation 1.6038A-2. The requirement or the need for foreign owners of U.S. single-member LLC to file a Pro Forma 1120 and 5472 was codified in this Treasury Regulation. And within this Treasury Regulation, the IRS provide some unique examples that kind of guides you to figure out what kind of reportable transactions the IRS wants to see. These are the two examples that the IRS gives you in this Treasury regulation. It's just 1 and 2 examples. There could be other situations that falls outside of this example that could be considered as reportable transaction. So this example doesn't give you all the reportable transactions out there. It's just give you some limited guidance on what the IRS think may be reportable transaction and not may. What the IRS think it's a reportable transaction based on the facts provided here, and then also based on the analysis provided in each examples and the conclusion that's provided. So these examples are very good in case you want to know what the IRS considers or what this Treasury regulation considers as a reportable transaction as it relates to foreign-owned U.S. single-member LLCs. Our work here, or the purpose of this video, is to put these two examples together and then specifically look at year 4 for this video. In the prior videos, we did the same thing. We put these examples together and then we figured out the transactions in year 1, year 2, year 3. So this one is going to be the final examples or the final video we're going to look at, which combines these two examples together. Now, before we take a look at the flowchart and go through the examples, let's take a look at who must file Form 5472. So in the IRS instructions, the 5472 instructions, the IRS specifically provided that a reporting corporation must file Form 5472 if it had a reportable transaction. So the two things we're looking here, which is very key, is you have to first of all ask yourself whether you're considered to be a reporting corporation, and then whether you have a reportable transaction, because you could be a reporting corporation, but you're not required to file these forms if you do not have a reportable transaction. So let's go all the way up and see how the IRS defines reporting corporation and which entities falls into this definition. What we're seeing here is a reporting corporation is either a 25% owned U.S. corporation. So it could be a corporation formed anywhere in the U.S. where owner is a foreign person and where that foreign person owns 25% or more of the entity. So if you have a situation like that, you have a reporting corporation. You could also have an LLC that has elected to be a corporation and where that LLC is owned by a foreign person and where that foreign person owns 25% or more of that LLC. Now, the second group is a foreign-owned U.S. disregarded entity. A U.S. disregarded entity or single-member LLC just simply means what it is. It means that it's LLC owned by one person, and that person could be a foreign corporation, a foreign person, a foreign trust, or a foreign partnership. Doesn't matter. As long as it's owned by one person, then it is considered as a reporting corporation. The third one is a foreign corporation that is engaged in U.S. trade or business, and where that foreign corporation have a reportable transaction. So these are the three entities that is considered as a reporting corporation. So now that you know the definition of a reporting corporation, the second step of the process is to figure out whether you have a reportable transaction. And it is because of reportable transaction that this video is being recorded. As I have stated, if you want to know what a reportable transaction is, the IRS has provided two examples here that gives you an idea of what they are looking for or what a reportable transaction is. Once again, these two examples is not all inclusive. You may have specific other situations that may fall outside of these examples, but still will be considered as a reportable transaction. So whenever you have those issues, you always need to consult with a tax attorney or CPA to figure out whether you actually have a reportable transaction or not. Let's look at the exceptions here. Normally, people would prefer exceptions. Exceptions basically changes the game. Failure to file them, filing them late, or not filing at all, or filing them incorrectly comes with a $25,000 penalty. So most filers, most people would have loved to get some exception that takes them out of this reporting to the extent that you don't have to report anything. Within these exceptions, the IRS provides 6 unique exceptions that one can use to be accepted or to exempt themselves from this filing. The only exception that we're going to take a look at is exception 1, because that generally applies to a foreign-owned U.S. single-member LLC. The rest of the exceptions here does not apply to U.S. single-member LLCs or disregarded entities. So we're not going to waste time on that. So let's take a look at the exception. The first one says that a reporting corporation is not required to file Form 5472 if it has no reportable transaction of the type listed in Part IV and VI. Now let's go to the form itself and look at Part IV and VI. This is Part IV. Generally, this part is applicable to U.S. corporations or LLCs that have elected to be corporations, or foreign corporations that are considered to be doing business in the U.S. where they have reportable transactions. So you go through all of this list to see if you have any transactions of any sort that is listed here. Normally, these transactions are expenses that either increases your U.S. tax base or decreases your U.S. tax base. And as long as it's related party transaction, it needs to be reported. So if you're a corporation, LLC that has selected to be a corporation or foreign corporation, you should be more concerned as to whether you have any transaction in Part IV or VI. And if you do not have any transactions in Part IV and VI, then the instructions here says that you as a corporation or LLC that has elected to be a corporation or a foreign corporation is exempted and you're not required to file Form 5472. As you read here, the sentence stops here and then there's a comma. When you read after here, it says that in the case of a reporting corporation that is a foreign-owned U.S. disregarded entity, they are not required to file Form 5472 if they do not have the type of transactions listed in Part V of the form. So let's look at Part V. Here, the IRS has stated or has instructed that foreign owners of U.S. single-member LLCs must describe on an attached separate sheet any of the transactions that is defined in the Treasury Regulations here. So if you have time, you can go read this Treasury Regulation and figure out all the transactions that could possibly be in this box. So the IRS basically instructs you to check this box and attach a separate sheet to describe all the transactions. If you read further, you can see that the IRS have summarized some of the common reportable transactions that a foreign-owned U.S. single-member LLC could have. And this related to such as amount paid or received in connection with the formation, dissolution, acquisition, and disposition of the LLC. It also includes contribution to and distributions from the LLC. So if you have any of those transactions, you will check this box. Now, as you can see from this part, these transactions here are very broad. So it's very difficult to have an LLC that will tell you they don't have these transactions. This box covers a whole lot of transactions that you need to be very, very careful about when you're saying that you're exempted. Most of the time, LLCs that I have dealt with are usually not exempted. You have to be careful and analyze your transactions very well to see if your activities fit into this box or whether your transactions fit into this box. However, if we go through all the transactions that has taken place and there's nothing to report here, then the instructions here says that you're not required to file Form 5472. So what you have here is for corporations, LLCs that have elected to be corporations, and foreign corporations. And then what you have here is for U.S. single member LLCs that's owned by a foreign person. So that's all clear. Let's go to the flowchart and look at the examples. And these specific examples, we're going to focus on year 4. We combine example 1 and 2 together, so we're focusing on year 4. So let's start with the fact. I'm going to provide the fact, the analysis, and the conclusion. So here it says that in year 4, X in liquidation distributes its assets to W. Now, in the prior videos that we've done, I did explain that W here is a foreign corporation. At least that's how the IRS started with it. But the W is not only required to be a foreign corporation. W could be a foreign person, foreign individual, a non-resident alien, a trust, or a partnership, etc. So W could be, as long as W is a foreign person, it's fine. So let's read the fact again. X in liquidation distribute its assets to W. So let's see how that shows in the flowchart. So here we see, if you've watched the prior videos, you would know that W formed X. So now X is liquidating. So X business is closed. X is transferring all the assets it has back to its parent, W, here in year 4. So that's what happened. Now let's move on. In the same year, Z distribute its asset to X and Y in liquidation. So let's look at this. So you have Z here. In the prior videos, I explained that W owns X. W formed this company. And then the same W also formed Y. Okay, so you could have W, which is a foreign corporation, forming X, a company in Delaware. And then the same W formed Y, a company in Wyoming. And then X and Y came together to form another company in, let's say, Florida. So you have these two. So it says that year 4, Z distribute its assets to X and Y in liquidation. So Z had these assets. Z had a house and this property here, the phone and the car. And when it was closing, it distributed it to both these companies, to both X and Y, because X and Y came together to form Z. So Z, when it's closing down business, it makes sense that whatever asset that's left in Z, after paying all creditors and everything, will transfer everything back to its owners or parent. And in this case, X and Y own Z, and that's why you're seeing that. I brought in this to show you the ownership structure. So W owns X, W owns Y. Now let's look at the analysis, year 4 analysis. Here, the IRS says that X, Y, and Z are disregarded as an entity separate from W. So this means that because X, Y is owned by W, X is a disregarded entity, Y is also a disregarded entity. Now the question here is, why is the IRS disregarding this entity? Someone may ask, if X and Y came together to form Z, shouldn't Z be a multiple member LLC? Why is it a disregarded entity? That's not correct. The IRS says that Z should still be considered as a disregarded entity. And the reason is simple. You have X here, which is a disregarded entity. It is very transparent. It's a flow through. You have Y here, which is also very transparent and flow through. These disregarded entities cannot come together and form a partnership because they are owned by one person. So if you look through the structure, because these are so transparent, you could look through it to see that it's actually W that owns Z and not X and Y. Because it's so transparent, W owns Z, but then for the purpose of the tax laws, we have disregarded X and Y. They cannot have a partnership. And that's why you see that the IRS says that X, Y, and Z specifically is also disregarded entity. Another analysis that the IRS gives is that X, Y, and Z are also treated as a domestic corporation for the limited purpose of filing pro forma 1120 and Form 5472. So that distinction is also important. When we say X, Y, and Z are domestic corporation for 5472, it means that 5472 is the only form that they're supposed to file, and filing the pro forma 1120 and the 5472 does not automatically transform your LLC into a full-blown corporation. If you want to be a full-blown corporation, you file Form 8832 to be a corporation. But if you have not taken an affirmative steps to make that election to be a corporation, then you're not a taxable corporation. You're just a corporation for information return purposes only. And so that distinction is also important. Now let's go through the analysis. It says that each of the transactions in year 4 is a reportable transaction with respect to X. Now when we say with respect to X, we mean that X is the company that files this information return and not W. So let's roll back and see. So here, X is going to file pro forma 1120 and 5472. It's going to check the box that it's filing a final return, and it's also going to declare or disclose that it transfers all these assets back to its parent. So that's what's going to happen to X. So that's why X has a reportable transaction. X also has a reportable transaction because it received liquidation. X in liquidation distributed its assets to W. So we've looked at that. X received assets or distribution from Z. So after Z liquidated, it distributed assets to X and Y. So let's roll back and see what happened. So in the same year, Z closed down business and distributed assets to X and Y. X got this car and this phone. So X is going to report on it 5472 and state that it received this asset from Z after Z closed business. So let's move on to Y. So here it says that each of the transaction in year 4 is a reportable transaction with respect to Y. Now, why does Y have a reportable transaction? Let's go back again. Y has a reportable transaction because when Z closed business, it distributed the house that's sitting in Z to Y. Or you could say that it distributed whatever asset it has in common to X and Y. But here, for simplicity's sake, we are assuming that Z gave the house to Y, and then we have Z also giving the phone and the car to X. So it's just as simple as that. All right, so let's look at Z. Each of the transactions in year 4 is a reportable transaction with respect to Z. Again, when we say with respect to Z, it means that Z is a company that files these forms and not the parent. So let's roll back and see. Z is going to file Form 5472 and declare that it closed business and distributed these assets to X and Y. Now, one will ask, why is XYZ filing separate 5472? The IRS does not want these entities to consolidate or combine their reports. So the IRS says that each of these entities need to file their own 5472. So you would have a duplicative report. So for example, Y is going to report that it received a house from Z. Z is going to report that it distributes a house to Y. So it's just that duplication is going on. And then finally, the IRS said that X, Y, and Z all have section 1.6038A with reporting requirement, which means that X, Y, and Z will have to file pro forma 1120 and 5472. They also have a record maintenance requirement for year 4. So when we say record maintenance, it means that all these transactions that these entities are going to be reporting on 5472, they need to have some kind of an internal documentation. Internally, they need to have a record to show that these transactions actually took place, because IRS may come back in the future to ask more questions about the transactions you reported and whether you have any documentations to back it. So the record maintenance is also very important. I know we talk a lot about filing, but you also need to be aware that there's a record maintenance requirement, which also comes with a penalty if you fail to do so. Let's go to the due date. For all these year 4 transactions, the due date is going to be April 15, year 5 for all of the entities here. If you are a calendar year generally begins from January 1 to December 31st. In this example, we could say that all these transactions may have occurred anywhere between January 1 and December 31st, year 4. And after the calendar year ends on December 31st, you have to file your return on the 15th day of the 4th month. 15th day of the 4th month simply means that April 15. If April 15 falls on a weekend or holiday, then the next business day becomes the new deadline. But you always need to have that April 15 date in mind. Now, if you cannot file the return by April 15, then you use Form 7004 to seek an extension. The extension gives you 6 months to file the return. So instead of April 15, if you file your extension on time, you have up until October 15 to file this information return. Remember that you cannot wait until April 15 has passed to file an extension. If you do that, the extension is invalid, it's void, and it will cause your return to be late because you filed an invalid extension. So the extension always should be filed on or before April 15 or on actual date April 15. So I hope this video helps you out, and if it does, or you have any questions, please feel free to use the link below to book an appointment with me. Thank you very much. Have a great day.